A few words about my background. I am a professor of shipping finance at Bayes Business School. In my previous position, I was at the Baltic Exchange developing market indices and benchmark. I'm a full-time academic, but I'm also very closely involved in the industry as a practitioner, advisor, and also providing executive education, as well as being a fellow of the Institute of Chartered Shipbrokers. One of the particular research areas that is of great interest to me is the area of shipping risk management. In particular, how shipping companies can manage their risks, manage their financial risks using financial innovation, using contracts like FFAs and options. And these are some of the topics that I will be discussing in my presentation. So, quick overview, what we're going to discuss in my presentation. I will discuss about the risk-return profile of freight rates. I'm also going to look at how one can manage freight rate risk using options. And finally, we will look at the financialization of freight markets. And the Q&A session will be done later on, I presume, synchronously. So, managing freight rate risk. Why is it important? Why does it matter? What is important to note here is that freight is a significant but also unique risk. Freight rate is one of the most volatile asset classes. To give you an example, one way of assessing the volatility or of measuring the volatility of the freight markets is through the implied volatility of options. So in other words, looking at what is the level of volatility implied by the prices of options in the market. And in that respect, options, and in particular FFA options and options on, for instance, the benchmark VLCC route TD3, are in excess of 100%. So they are very, very volatile. Obviously, 100% is a very high volatility. But to put that in perspective, you look at, for instance, the US stock market, the annualized volatility there is about 20 to 15%. So VLCC freight rates are 5 times as volatile. You look at the crude oil market, crude oil volatility is about 40%. So again, VLCC freight rates are very volatile. And even if you look at, for instance, a very volatile asset class like, for instance, Bitcoin, which is very much on the news lately, again, typical volatility of Bitcoin is about 80%. So VLCC freight rates are more volatile than most other asset classes. And that tells you one very important thing. Freight rate risk is an important risk that should be managed in its own right. How do you actually manage the risk? Well, usually using financial derivative instruments. People, market practitioners believe that you can hedge freight rate risk using commodity prices. For instance, I can hedge VLCC freight rates using crude oil futures. But the truth of the fact is that freight as an asset class has low correlation with most commodities. Therefore, freight rate risk should be managed in its own right using tailored hedging instruments. So among these instruments are FFAs, forward freight agreements, as well as options. Options are by far a much more interesting asset class. Options are the ideal hedging instrument. They are the ideal hedging instrument in the sense that they provide downside protection and upside participation. So as an owner, for instance, I can buy FFA put options that will provide a guaranteed minimum level of freight rate income, and that would be a floor. If freight rates increase above the minimum threshold, then as an owner, I will have participation on the upside. Equally, as a charterer, I will be buying call options. Call options represent a cap, a maximum freight cost that I will be paying in the market. If freight rates go higher than the cap, my maximum freight cost will be the cap rate. But if freight rates drop below the cap, I will be able to take advantage of lower freight rates in the market. So in a sense, options provide the best of both worlds for the hedgers. Protection if the market moves against you, participation if the market moves in your favor. FFA options are cash-settled contracts, which is a very important prerequisite in the sense that it facilitates trading without having the complexities of providing physical delivery of a vessel or of a cargo. The settlement is calculated as the monthly average of the corresponding Baltic assessments, and the contracts are OTC cleared, which is very important. They trade in a liquid secondary market and of course provide price transparency. And what you see here on the right hand side are indicative quotes for options. So we have quarterly and calendar contracts for Cape sizes at the top and Panamaxes at the bottom. So you can see the FFA rate as well as the corresponding premium for the options. Obviously, you can see that the level of the premium tends to be expensive in a sense, but that of course reflects the fact that we're talking about a very volatile market and a market that is primarily designed for the management of risk, and therefore it is expected that if you buy an option, if you buy a put or if you buy a call, you would have to pay a premium that may be reasonably high. So who is actually participating on this market? Who trades in the FFA options? Obviously you have the traditional players. You have the owners and the operators on the dry market. You have the charterers and the traders on the other side, but also you have financial participation. It's difficult to give you exact numbers on each one of those categories, but I would say that this is largely a market where you have more charters and traders and fewer owners. The reason for that is that charters, traders, commodity traders in particular, are much more keen to hedge their freight cost. For them, freight is a cost element, therefore having price certainty on the freight component is a must. For owners, on the other hand, freight represents a potential source of, freight is the main source of income, so they would also like to take advantage of the upside in the market. Very interesting in that respect, it is also the participation of financial players, banks, funds, exchange-traded funds, and this is something that is happening with far greater frequency in the freight market. We have far higher participation of investment banks and hedge funds compared to what may have been the case a few years ago. And this participation is very important. It is important because these players actually provide liquidity. They inject liquidity in the market. Therefore, they can provide necessary liquidity which facilitates smooth trading among the players. So I have here some examples in terms of how an owner, for instance, could use the options. I guess the most fundamental strategy is what we call a floor, and floor involves the owner buying an FFA put option which provides a guaranteed minimum freight income. So by buying a put option, effectively you buy a floor and the strike price of the option represents the minimum freight income. If freight rates drop below that threshold, then you will be protected and you will receive the minimum income. But if freight rates increase above that threshold, then obviously you will take advantage of the stronger freight income in the market. Quite often, owners are very strategic in terms of how they set the strike price, and usually they set the strike price equal to their break-even rate. So, in other words, the threshold, the freight rate threshold or the income threshold which is required for them to be able to just break even in their calculation. So in other words, to be able to cover OPEX plus CAPEX. Equally, owners could also use FFA options in order to participate in the market. So if an owner has time chartered out a vessel, say a Cape-size bulk carrier, can buy FFA call options to have the flexibility to take advantage of higher freight rates in the market. And finally, one very interesting strategy is to use index-linked contracts combined with options. Index-linked time charter contracts is something that has become commonplace, especially in the dry market. In an index-linked contract, the freight rate that the owner receives depends or is based on some market benchmark like the Cape-size 5TC or the Panamax 5TC index. One can combine this level, this type of contract with floors and caps. So in other words, as an owner, I would set a minimum threshold for income, a minimum income level in a period contract, so that would provide a floor. Obviously, buying a floor, buying a put option costs money, so you would tend to subsidize that by selling a call. So in other words, sacrificing some of the upside potential that you can have. So in that particular case, you would have a level of rate income that is between the minimum and the maximum, or as we say, it is a collar. So here are some of the strategies. I have two more examples to show you. One very interesting trading strategy with options is trying to exploit sideways movements in the market, similar to what you see here, for instance, where, as you can see, you have a minimum and a maximum threshold. So if you believe that the market in that case is going to stay within the narrow range between, say, $20,000 and $40,000 a day, then one way of trading and benefiting from that strategy is by construct a strategy known as a strangle. A strangle is a strategy that consists of selling a call option and selling a put option and results in this distinctive shape that I have highlighted here. Equally, one could also use options for the purposes of constructing synthetic profit share agreements. So in other words, you time charter out your vessel at, say, a fixed rate of $24,000 or $25,000 a day, but then you want to have an agreement with your counterparty where if freight rates rise above a given threshold, you split the difference. So if the market goes, for instance, to $40,000 a day, you split the profit, so the owner gets $32,000 a day instead of $25,000 a day. And this is, again, an agreement that can be structured quite easily with options. So in that particular instance, the owner will buy a call option, but instead of buying one full call option of 30 calendar days for a month, the number of days that he will buy will depend on what percentage of profit share he wants to achieve. So if he wants a 50 profit split, 50-50, he will buy 50 days in a month. If he wants 25 profit split, he would buy 25% of the days in a month. So 50% of the days would be 15 days, 25% of the days is something like 8 days, and so on and so forth. So the last item I want to touch upon in this brief presentation is the role of financialization. And this is something that is becoming very, very important, and it is, in my view, something that is going to revolutionize and reshape the industry going forward. So the main advantage of FFAs and options as a trading tool is that they have turned volatile earnings into tradable exposures. So this has attracted new pools of capital into shipping. Companies pension funds, hedge funds, commodity index funds. Shipping is a very nice industry to invest in. It is very volatile and has low correlation with most other asset classes. So it is in a sense a very good diversifier to have in your portfolio. Being able to trade financial contracts like FFAs and options provides a number of advantages, and most importantly, it provides the necessary liquidity to attract new capital. So you have therefore sophisticated traders that look into the FFA and into the options market in order to invest new capital. This liquidity is essential because having liquidity means that now physical market participants, owners and charterers that want to hedge their risk, can do so efficiently in the FFAs, can do so by buying and selling FFA contracts knowing that there is going to be liquidity in the market. But this injection of new capital will also have another fundamental impact in the market. If we look at the main challenge that our industry is facing is that of decarbonization. Decarbonization, among other things, will depend on the availability of capital to invest in new technology. Well, probably these financial innovations are ways through which this innovation and this development can take place. And that concludes my presentation. Thank you very much for the attention, and I very much